Hi, welcome back to my channel. It's Sarah from Meridian Accommodation, and in this video I'm just going to talk to you a little bit about tax. So as a property investor, we want to be as efficient as possible from income tax, inheritance tax and capital gains tax. Now to do this, there are two key rules that we have to follow. They are an absolute must. So the first one is never, ever, ever sell your investment properties. In another video, I'm going to teach you how to buy amazing properties so that you never want to sell them anyway. And the second rule is, as my property increases in value, increase my debt against it. Now, if this makes you feel a little bit nervous hearing that, don't worry, that's absolutely fine. Click the link in the description below to take you to my video on good debt versus bad debt. And in that, I'll explain why this concept is okay. So now let's go into a little bit more detail about income tax. So to help explain this concept, let's imagine we have two identical people. Let's call them Chris and Sue. Now, Chris and Sue are identical in every way. They have the same properties, they have the same jobs, they have the same incomes. That's the important part. Now, let's imagine they both buy this property here. It costs them $90,000. They have an interest-only mortgage of £67,500 at 4.5% interest. And they get the rent of $650 a month, and then these are their expenditures. So their mortgage payments are £253 a month. They've got maintenance of £80 a month. Now we work that out because roughly a 3 to 4 bedroom property has a maintenance bill of £1,000 a year. So divide that by 12, gets you the £80 here. So the building's insurance will be about £20 and the letting agent fees will be about £78 per month. You should always use a letting agent. Don't try and do all that work yourself. So when you minus all of these off the rent, you get a net income of £219 per calendar month. So let's now look at how we can use this example to become tax efficient over time. So let's imagine that our first person, Sue, she hasn't watched my video on good debt versus bad debt. And by the way, if you haven't either, click the link in the description below and it'll take you to that video. Give it a thumbs up. So she hasn't watched my video. She believes that debt is really bad. She's a saver. So she goes ahead and pays off this £67,500 mortgage, and her mortgage payments each month go to zero. That £253 goes straight to her bottom line of profit. So her net income is now the £219 plus the £253 per month. She's thinking, great, this is wonderful. But there's a slight issue. So what do you think the government's reward is to Sue for paying off her mortgage? Remember at the start we had Chris and Sue, and they both had the exact same situation, but now Sue has paid off her mortgage. She's got an extra $253 on her bottom line. Well, the reward that the government gives to Sue is that she now has to pay an extra £100 a month in tax if she's a 40% taxpayer. So that's an extra £1,200 per year of tax that she has to pay. Not very income tax efficient. But Chris, he's got another issue. So let's go have a look at what Chris's issue is as well. So let's look at Chris's situation now. Chris didn't pay off his mortgage, so he's still got this £67,500 mortgage. And if he was clever, he would have taken that money and gone and bought more investment properties so he could get the equity growth of those as well. But let's just look at this example here. So every single year, he will increase his rent by 3 to 5%. So it will go from $650 to $670 to $690 to $710 and onwards each year. Now the issue with that is if he's not careful, that extra money will go straight to his bottom line in profit. And he'll have the same issue as Sue that we talked about before, where her income tax will increase. So to offset this, he can do two things. The number one, he doesn't really have to do anything. His maintenance payments will increase over time due to inflation. So eventually this will go up to about £90 a month. That's not enough to offset the big increase in profit up here if it goes to his bottom line though. So the second thing that he can do is he can go to the bank and get the property refinanced because his property will go up in value. On average, the property market goes up 7.9% every year, and it has done this consistently for the last 80 years. So he can be pretty confident in going to the bank once his property has gone up in value and asking them to refinance it and remortgage on a 75% loan. So his mortgage payments will go up, but the bank knows that he'll be able to pay them off because he is increasing his rents every single year. So his mortgage payments will go up, and his maintenance payments will go up, and these will offset the extra rent that he's getting from putting his rent up. So overall, his net income will stay roughly the same at this £219 per calendar month, and that's how he can remain income tax efficient. So the main thing to remember here is, as your property goes up in value, increase your debt against it to remain income tax efficient. So let's now look at capital gains tax. So Sue and Chris, again, they're both going to buy a property that's worth 100k. Now, in the UK, house prices double every 8 years on average. We're going to be cautious and say that they double every 15 years in this example. So their property that starts out at 100k, in 15 years is going to be worth 200k, in another 15 years it's going to be worth 400k, so on and so on. But Chris, he forgets rule number 1. Now, as a reminder, rule number 1 is never, ever, ever sell your investment properties, and you're going to see why in a minute. But Chris, he forgets this, and he decides that he's going to sell his property at this point here when it's worth 400k. So he's made a 300k gain, and that's illustrated here, so he decides to sell. If he's a 40% taxpayer, then the government says that he has to pay a 28% capital gains tax on this 300k gain. Now that equates to roughly £84,000 here. By the way, if he was a 20% taxpayer, that would come out to roughly £54,000 here that he'd have to pay in capital gains tax. So let's say at the end of all this, after he's paid his solicitor's costs and things like that, Chris is left with £300,000 in his bank account. Now, the other alternative is Sue. She remembers rule number 1 and she decides not to sell her property at this point here. Instead, she knows that as her property goes up in value, she can increase her debt against it. So she goes and refinances her property and gets a mortgage, 75% of this 400k here. So she gets 300k, and that goes straight into her bank account as well. So what's the difference here? You've got Chris and Sue. They both have 300k in their bank accounts. Well, the difference is that Sue still owns this property. She's only remortgaged and refinanced. She hasn't sold it. So she still owns this property. Now, what's going to happen in another 15 years? Well, that property is going to be worth 800k. What about another 15 years? 1.6 million. So by Chris selling here at this point, he has lost out on £1.2 million worth of growth that he could have had if he hadn't sold his property. So remember, rule number 1, never, ever, ever sell your investment properties, and that's how you remain capital gains tax efficient. So now we're going to look at inheritance tax. So when you pass on, the first $325,000 that you pass on is inheritance tax free. And if you're in a couple, then it's the first $650,000 they add together. Now let's say in this example that that allowance is made up of things like your residential property, cars, things like that. So we're only looking in this example of paying the inheritance tax on your property portfolio, your investment portfolio. So let's go back to the examples of Chris and Sue. Sue didn't like debt. She decided that she was going to pay off all of her mortgages so that she didn't have any debt on them. So when she passes, she has a portfolio worth £1 million, but no debt on it. She passes this on to her kids, and her kids get told by the government that they have to pay 40% tax on the million portfolio, which comes to 400k tax bill. Now, Sue probably didn't know when she was going to die, and it might have been during a falling or a flat market. And if this is the case, then the kids will probably only be able to sell the portfolio for 15 to 20% less than its market value. So that's roughly 800,000 minus the 400,000 tax bill. Then the kids are left with only about 400k out of this entire portfolio that they get to keep. In this example, Chris, he knows that there's a difference between good debt and bad debt. And if you don't know that difference, then click the link in the description below to go to my video on it, and I will explain it there for you. So he has a portfolio worth £1 million as well, but he has 750,000 of good debt on it. So his equity is only 250k, and that's what the 40% tax is payable on. So his tax bill, well, his kid's tax bill, is only 100k rather than 400k. So even if Chris dies in a falling or flat market, The kids still get to keep 800k minus 100k, they still get to keep 700k, rather than in this example them only being able to keep 400k. So I definitely know which one I'd rather have as the kids and which one I'd rather pass on to my kids as well. So remember, rule number 2, when your property goes up in value, increase your debt against it, and that's how you remain inheritance tax efficient. So I hope you enjoyed this video. If you want to learn more about the benefits of refinancing your investment properties, I will be making a video about this really soon. So remember to subscribe and hit the notification bell to be told when I post that video. As well, remember to give this video a big thumbs up if you learnt something new, and I will see you in the next one. My name is Sarah from Meridian Accommodation. Happy investing, and I'll see you soon. Bye!